welcome back. Well, managed workspace solutions company IndiQube Spaces 700 crore IPO will open on the 23rd of July. The IPO comprises of a fresh issue of 650 crores and an OFS of around 50 crores. Our colleague Reema Tendulkar caught up with the top management of the company, began by asking about the IPO itself.
If you look at, we were following the IGAP accounting standards till 2023. And then in the last 2 years, we have moved to the Ind AS accounting standard. And as per the IGAP accounting standard for the FY23, we have reported a profit as per the income tax filings that we have done. And in 2024-25, because of the Ind AS accounting standard is where basically we are seeing losses. As you may have seen that our EBITDA margins look very, very promising, like 58% at the overall. Now, obvious question people ask is that from such a high EBITDA, how suddenly you are having losses? The thing is that whatever rental payouts that we do to our landlords, they are all capitalized and they are also treated as a liability from a payment perspective, and those do not factor in the EBITDA. So as a result, you see very, very high EBITDA margins.
So the lease rental is excluded from the EBITDA.
Yes.
It comes in below as
Correct.
line item.
Correct.
Okay.
So that is where you see extremely high EBITDA. Then when you move down, what happens is, since this has been treated as an asset and a liability at the same time, so there is a significant amount of depreciation and interest that is notionally computed as per accounting standard. Now, that is way in excess of the actual rents or the actual depreciation that we have on our basically physical assets.
So given the recurring losses under the accounting standards, should investors assume that the company will continue to report losses, statutory losses, or will the company break even at the PAT level?
So if we look at the Ind AS accounting standard for any lease that has been capitalized, initially the impact of depreciation and interest tends to be higher for that, and over a period of time that impact starts reducing. So I think if we factor into that, and as business starts growing, at some stage this will turn.
Let's look at your cash EBIT. Your cash EBIT margin is at 10.8%. Is that the industry standard? And is there headroom to improve this number? And if yes, what would be the levers? Would it be operating scale? Would it be pricing?
So what we see is that if we were to give the past data, definitely we see that this number has improved. We believe that there is a lot of operating leverage that is available. Plus, we have made significant investments into green power. We have commissioned a 20 megawatt solar plant in Karnataka, out of which more than 50% is already operational over there. So we see a significant amount of savings should accrue to us on account of those investments as well.
So now just to understand and to summarize what we've spoken so far, under IGAP, the company turned profitable in FY23. It's showing a loss purely on account of Ind AS accounting. The correct margins to look at would be the cash EBIT margins, which are at 10.8%, but there is scope for those, there is headroom for those cash EBIT margins to go up. I mean, you all have a fundraise of about 463 crore, which will be used for CAPEX, for increasing the pipeline. So your current AUM is 6.4 million square feet and the active stock is 6.3 million square feet. Explain to us what this pipeline will look like, the AUM that you will manage, say, once you deploy all the money.
So as you rightly said, the AUM is 8.4. So there's a headroom of 2.1. If you can see from 6.3 million square feet of active stock between 8.4, you have 2.1. And our capex cost is about 1,500 rupees per square feet. So for that, 2 million into 1,500 would amount to almost like average about 300 crores would be going to kind of cover that 2 million square feet. And the balance 150, we have actually kept the buffer for the growth. So that is how the whole 460 crores which you're seeing would be utilized in the capex.
Rishi, your revenues have practically doubled in 2 years. And I think the revenue CAGR is like close to 35%. So you've outpaced the industry. In this period, what was the industry growth rate and can you continue to outperform?
Yeah, so if you look at the CBRE data, the year that got over, the calendar year 2025, was done at about 100 million square feet of managed office space. This number was about 80 million a year back. And as per their forecast, in next 2 years, this number is likely to go to about 140 million. So the industry has grown and looks likely to grow at a very healthy growth rate, about 20%. And somebody who has a large presence pan-India in about 15 cities, we feel that we will be able to continue to do better than the industry average. And if historical data is any indication, I think that's how it looks like.
What percentage of your FY25 revenues, for instance, come in from global capability centers? And could you provide a segmental breakup of your revenues?
In terms of seats, if I have to go, it's a 63% comes from more than 300 seats. So we are pretty much practically, large customer, long stay customers. So more than 300, I said 63%. Out of that, 44% is GCC and 56% is your Indian MNCs, large conglomerates, also includes the startups of the world.
How is your business model different? There are so many companies. Like last week we had this week we had SmartWorks listing. WeWork is looking to file its papers. It's got the SEBI nod. How is your business model different? Very quickly.
So basically, we are the integrated workspace solutions company. So when we go to the large enterprises, we do not say, okay, we have about 100 plus centers. Can you come to one of my buildings? Instead, we go with a solution-based approach. We ask them, what is your real estate needs? Where is your talent located? And accordingly, we do the solutions for them. So there are times when they say, okay, we do already have a center, but can you design and build for us, which is our bespoke model? Or can you give us the services, which is our one model?
Provide a lot of value-added services, which is your differentiating factor in terms of a business model, where you provide bespoke services, catering, transportation, whatever the company basically requires. That's about 12.7% of your revenues as of FY25. Does that number go up and does it command higher margins?
So if we see, again, I will give the historical data that 3 years back, this number was about 9%. And it has been growing because what we have seen the trend is that once a customer comes to us, they like us, they start buying more and more services. A lot of B2B and B2C services is what they add. And that is where if you look at our multi-center client revenue has also grown substantially to about 44% over there.
What does that mean exactly?
It means that typically what happens when a customer comes to us, they take up space in one of the buildings or centers, and once they like, then they expect us to do more. They take more spaces either in our centers or they expect us to provide services or...
So 44% of your revenues come from clients who have offices in more than one space with you.
Multi-center.
Yes.
Multi-center.
Yes, multi-center we call it.
Who are your big investors right now in the company?
So we have one institutional investor, Westbridge, and they have invested 190 crores till date. And the promoters have invested about 125 crores. We have an individual investor, Ashish Gupta, who is on our cap table as well. And total equity raise has been only 325 crores